Hi, this is Mark from Right Line Trading to explain to you our new bias indicator. The indicator is extremely unique in as much as it's not affected by any price action that you see on your trading chart. What it does is it assimilates data from higher time frames and projects it on your trading chart, whatever that may be, whether it's an 8 range, a 13 range, a tick, or a time. The bias indicator will adjust its higher time frames and project data from those higher time frames accordingly. So nothing that takes place on the chart in terms of price action affects it. And what we've done is broken price action into or bias into three colors. Now, on an up move, and we're looking at gold. Okay, here is where we have, I'm trying to find a place where we project all three up colors on gold, and we do right here. On the dark green here, this is where price action on the higher time frames has broken all resistance to the upside, and in addition, price action has set up such that it strongly favors a move to the upside. This is really where you have strong bias to the upside. And if you look, remembering that price on our trading chart is not affected, does not affect the bias indicator, you can see how the higher time frame price action and support resistance levels affect and are predicted by the bias indicator. It does a great job of predicting direction, because in essence, because it's assimilating data from higher time frames, it really can be looked at as a leading indicator. And I think it's the first indicator of its kind that is not affected by anything that takes place on the trading chart. And it's the first indicator of its kind that doesn't use an oscillator, doesn't use a MACD. It's created only based on support, resistance, and price action. Now, this strong up color, green, corresponds to this dark pink color to the downside. This means that all support to the downside has been broken on the higher time frames, and price action aligns perfectly for the market to move to the downside. So you have the green and you have the dark pink corresponding to the strongest bias. Then on the up move, you have I'm sorry here. I don't want to squeeze the chart so you can compare them. So you have the strongest up bias here. Then you have the dark blue. The dark blue means that all resistance to the upside has been broken, but price action no longer aligns. So one of the components is dropped out of the bias indicator for an upside move. Still, you don't have to break any support to the upside on a move on our 8-range chart, which is our trading chart. But the strength of the bias has weakened somewhat. It is still an excellent place to take a long with green or with dark blue. Now, with light blue here, and this is almost I guess a cyan, and it's the lightest of the blues. This is where upside bias is weak. This is where price action doesn't align. You still have broken all support to the upside, but this is where price action is really out of alignment. And this is where you can take a long, but only with extreme caution. Now, I personally am not going to trade without some form of bias to the upside, either with the dark green here, strong up bias. Remember, all support to the upside broken, price action tells us we're going to go long. Here, we have all support to the upside broken, price action not so well aligned, but still bias is good to the upside. Here, price action not aligned, but all support remains broken to the upside. So it's a way of assessing the potential, the way of bringing the positive predictive value of a trade into the equation, the way of increasing precision, and really precision is in essence the positive predictive value of a trade. Now to the downside, we have our three colors as well, and they're projected right here. It takes a little bit of getting used to, but we have our dark pink. Again, this includes all support to the downside has been broken, and price action is aligning on our two higher time frames. This, all support remains broken, price action not so great, and then here is our weakest area of down bias, where price action really is not very well aligned for a short, although all support to the downside remains broken. Now, in between here, what you have is price is caught between the 15 and the 50 on higher time frames, and there's just no discernible price action to assess that can predict a move to the upside or the downside. So when there's no bias, there are really two factors. I mean, what we're trying to do basically is to find an area where there's just total chop on higher time frames, and that's what we're doing when we don't project bias. We're saying that the market on higher time frames is caught between support and resistance, and in addition, there is no alignment of higher time frames in terms of price action. We're not getting higher highs. We're not getting lower lows. We don't have an engulfing candle approaching a major trend line. That's what we're doing in these periods where there is no bias. Now, that's not to say that the market can't make a move. It certainly can, but remember, what we're looking for here is never to capture all market movement. It's simply to predict when we decide to enter a trade, what is the positive predictive value of that move. And although this doesn't really have anything to do with bias directly, I just wanted to let you know a little bit about sensitivity and specificity. Sensitivity, obviously, is really the mathematical variable we're looking to pick up all the true positives. That's where a very sensitive indicator is always going to be able to get you into all big market moves, because these are true positive moves. These are where if you have a 6-tick target, you're going to get your 6 ticks because it's a very sensitive indicator. So sensitivity looks to get you into the true positives. Now, specificity looks to keep you out of keep you from trading, because because it looks at the true negatives. That's where the market threatens to break out, but it doesn't. So there's a balance between sensitivity and specificity. And as you optimize one, it's always at the expense of the other. As you look to make market moves with greater and greater sensitivity, it is a mathematical theorem that you're always going to decrease specificity. You're going to drag yourself into more and more losing trades. And the object of specificity is to keep you out of the losers. It wants to get you into it wants to prevent you from trading by indicating to you which are the true negatives. Now, sensitivity over specificity gives you positive predictive value, which ultimately can be said in another way is precision. And that is the percentage of trades that ultimately are winners. But there's a variable that is called gamma that has to be put into the sensitivity over specificity equation before you can get positive predictive value, and that is prevalence. And prevalence simply is how many up moves are you going to get, or how many down moves are you going to get? Because let's say you set up for a move, and I guess it's difficult to explain, but what you want to do is define chop, because during chop you can get a potential move, but because the prevalence of a great move is unlikely, these are areas that you want to stay out of, because if you take sensitivity over specificity and multiply it by prevalence, and the prevalence of a good trade during chop is low, the positive predictive value of the ultimate outcome is going to diminish. That is why we must only trade the trend, and we must clearly define the trend before we take a trade. Now, when I do that in the trading room, I wind up with consistent winners. When I try to break the rules and I try to trade in an area where the trend isn't that obvious, that's where you lower prevalence, and even with the same sensitivity and specificity, you lower the predictive value, the positive predictive value of a trade. And that is what we're trying to do here with the bias indicator. We're trying to tell you where the prevalence of an up move is going to be the highest. Now, the prevalence of a long move is going to be highest when the bias indicator is blue. The prevalence of a down move is going to be highest when the bias indicator is pink. The prevalence of a down move is going to be a little less, it's going to come a little less often, or the prevalence is going to decrease a little bit when the bias indicator is light pink. And when we go to tan here, the prevalence will drop off considerably. We consider the prevalence of a potential move to the downside or the upside to be very low in between, although it can happen. So what we're trying to do here by giving you a bias indication is simply keeping you in the areas where the prevalence of a move to the upside or a prevalence of a move to the downside is going to be the greatest. And with that, a signal which has a fixed sensitivity and specificity is ultimately going to provide you with a positive predictive value of the greatest number. So if you understand that, then you understand the rationale behind what I try to do by creating the bias indicator. Now, you cannot indicate an increase of prevalence based on anything that takes place on your actual trading chart, because the analysis of data from your trading chart is already assessed in the indicators that you're looking at. And although a lot of our indicators do an analysis of multiple time frames. There are fractal indicators. The only way to actually look at prevalence is to look at something that is an independent variable, a variable that has nothing to do in any way with your trading chart. And although the indicators we have analyze data from multiple time frames, one of the time frames they look at is the trading chart time frame. So how price moves on the trading chart affects order flow, stochastic, and momentum, because one of the time frames it analyzes is the time frame we're trading. What allows this to be a leading indicator and to actually give you a prevalence is the fact that it doesn't use any data from the trading chart time frame. It only looks at two higher time frames. And this really, really does tell you when the prevalence of a long move and the prevalence of a short move is going to skyrocket and is going to take the fixed sensitivity and specificity of a signal, such as a C candle entry, and ultimately give you a positive predictive value of where we really want to be, which is we want to be greater than 85%. We want 85% or more of our trades to work. And if you look at today, where we took 2 trades and 2 winners, we took them both with bias, and they both work great. Yesterday, I took a bunch of trades. It was the first time we really projected bias, and I took some trades without bias, and they were losers. So we're just going to stay with bias, and we're going to use this. Again, in closing, it's an extremely unique indicator, extremely powerful, and we make this available free to everybody who has our software. We don't charge for this upgrade, although I have to tell you, it's taken us an enormous amount of work in order to do it, and I know a lot of people have been pressing us to send it out and asking us where it is. We have been tweaking it. And it's really gone through. It's been morphing and morphing and morphing. And the last version only had 2 colors, but I did not feel that defined prevalence well enough. I felt that we needed to have 3 separate colors to define a market setup, but really structurally, and using support and resistance, using 3 colors. That would give us the best way of defining prevalence. And I think we've got it. So we're going to be sending it out today in the afternoon. Today is 11/14/2014. We're going to make this a part of our standing platform. And it really, really is an amazing indicator. And I'll just show you real quickly. I don't usually take very many gold trades, but I'll show you some. Now, a lot of these trades were taken before we had the bias indicator inserted. So let's go backwards and take a look. Now you can see this is a really good down move that did not occur with bias. Here's an up move. We took this in the room today. Order flow, stochastic, with us on the trade. Bias is green, 20 ticks. And you can see throughout the period of time when the chart is green how irrespective, remembering that price action does not affect the bias indicator, how the market just is trending to the upside. Now here's our weaker area of up bias, and it does flatten and then begin to move up to move into an area of stronger upward bias. Here's our strong down bias. And you can see these great signals. This is coming at 0:31:34. It's coming in the middle of the night. We're not going to be trading it. I don't want to do this, ad infinitum, but I do want to. Okay, here's 14 ticks with bias. We took this in the room on Thursday. Here's 11 ticks to the downside with bias. You see the retracement and the move down. 14 with bias. The retracement, the movement down. 11 ticks with bias. Now here's a loser with bias. And believe me, they're not all going to win. Now these are two losers I took in the room with no bias. The indicator really wasn't set up exactly as we have it now. And this was really hitting an area of support on a higher time frame. Did not have price action set up, and it cost me dearly. Same here. I had three losers in a row. Thursday was a very difficult day for me to trade. And each of these trades was taken with no bias. If I would have traded with bias, I'd have wiped these off. Here's a short trade. Direct entry system had disengaged, but I called it in the room. This is a 26 tick winner with bias. Another trade, 9 ticks with bias. And everything I'm showing you are live trades taken in the room. This is a great trade that I missed at 2:30 in the afternoon. Short trade with bias. These are 3 trades I took in the room. +6 with bias. +12 with bias. +10 with bias. +5 with bias. A loser, no bias. So far, out of the 5 losers that you've seen, 4 of them were taken without bias. A winner with bias. Now here's a loser with, right back here though, whoops, is a big winner with bias. 32 ticks. Remember, I didn't have the bias indicator when I took these trades. So this retrospective look at the trades really shows you how really helpful it is. Now there was a 5-tick trade I took without bias. I just made it. 17 ticks with bias. Another loser without bias. So you can see that out of all the losers I took, and this is a tough week, we eked out a profit, but not by much. And it was very choppy. It was low volume, and I could have wiped off 80% of all my losers simply by not taking the trade without bias. Most of the winners, 90% of the winners I took, were with bias. So if I would have used bias, it would have eliminated about 80% of my losers and only 10% of my winners, and really, really turned around the equity for the week on crude oil in an amazingly positive way. And this is the way that we're going to trade today, with bias firmly in place and everything cranking out exactly right, so that we can actually give it out. I had this 20 tick long, and then on the Russell, I had this 20 tick short with bias. And that was it for the day. We made almost $500 on 2 trades, trading 4 contracts. Wasn't going to put anything more at risk on a Friday. And that's how much the bias indicator is going to help us in the future. It's going to be an amazing addition to a platform that already does fractal analysis and relies heavily on market structure to provide us with a prevalence, the one variable that we've never been able to multiply to sensitivity over specificity to give us a real positive predictive value, where you can backtrack and look at the number of successful trades you have and calculate positive predictive value. But now eventually we can actually calculate the prevalence and come up with a hard number. It's going to take a lot of work, and it really isn't particularly relevant. We just know a priori that the prevalence of a short trade is going to be much greater during short bias, and the prevalence of a long trade is going to be or a long move is going to be much more prevalent during up bias. And with prevalence increasing, sensitivity over specificity times prevalence is going to give us a positive predictive value that is higher. And that's what we're looking to do. I mean, our platform looks to define risk, and the bias helps to diminish risk by giving us a prevalence and allowing us to come up with a more hard value for positive predictive value, for the positive predictive value. So that's really bias in a nutshell. If you have any other questions about it, you are welcome to give us a call. Let me give you our number. And you're also welcome to take a trial in the trading room. I knew I put up the wrong slide, and I think we do revolutionize day trading. We provide, I mean, the market is just filled with programs that trade one time frame with this with rehashed oscillators and MACD and just the same stuff you see where people just rename the indicators. This is really a different kind of program. I mean, we do fractal analysis, and we really combine the best of both worlds. We understand that no indicator confluence, no indicator signal is going to get us into a trade with any kind of reasonable positive predictive value without looking at market structure. And we also know that market structure will not do it without looking at indicator confluences. And we also know that you have to trade multiple time frames in order to create a decent positive predictive value. And now we've combined that with our bias indicator to come up with what I think is the most powerful trading platform in the world. Obviously, I'm a little biased, but I've really never seen one better. So you can go to www.rightlinetrading.com and click on the link. There we have a link to our daily net equity in the trading room, a link to our daily net equity on the auto trader. You can email us at info@rightlinetrading.com, and you can call us at 1-855-765-6681 anytime if you have any questions. So everyone have a wonderful day, and we'll be getting that new bias indicator out to our members sometime this afternoon. Take care.